Hi everyone, Jason here. We'll be talking about personal finance in this episode. Hopefully, it goes without saying that this is not financial advice and you should seek out professional guidance before undertaking any strategies we talk about in the show.
Hey folks, you're listening to the Idea Roastery. I'm Herman.
And I'm Jason.
Jason, when did you invest your first dollar or your first rand, and what would be the case?
When I was very young, like probably 12, 13, 14, I had a bank account, and the bank account it was one of these like child bank accounts. I think it was with ABSA or something. And you had this savings account. And in a certain sense, I think if you think of savings as an investment, that was probably my first sort of introduction into it. So I had a savings account, and I guess I would get pocket money and stuff like that from my parents, and then they would deposit it into the bank account, and it would either just sit there or you would like take it out and spend it on buying sweets and stuff. But then I was thinking another time that it wasn't necessarily an investment, but in school, in primary school actually, was it primary school? Maybe high school. We had this economics and management sciences class where we were told to go home, find a newspaper, look into the back of the newspaper where they had all of the kind of stocks, and they said like pick 3 stocks, and then tomorrow you come in or next week you come in and you're going to tell us like why you picked these 3 stocks. And so I went home and I looked through the newspaper, and I like went through like a couple of them, and they all had these like weird ticker symbols, and I had no idea what they were. I saw this one that was like DI Data or something like that, and there was like some insurance company like Sanlam or something like that. And then we didn't necessarily invest at that point, but it kind of like got me into this idea that you could do something with a company. I guess I didn't really know the full like how it worked, but funny enough, if I had invested at that point, it would have done really well, because this was like sort of as like the tech boom started off, and I think DI Data did really well as like a data center company. But yeah, that was the first kind of like introduction to it. But I'd say like my first sort of investment in terms of like stocks, it was probably after I started working, which was probably around 2014 possibly, and before that it was just savings. How about you? What was your first foray?
Man, like I had some unit trusts when I was younger, facilitated by my mom, and so those were technically my first investment. But it was one of those ones where like I didn't have a lot of pocket money, and so I'd put money into the unit trusts, and then I'd want to buy something, and I'd withdraw them. And in hindsight, I actually probably amassed more in fees than I ever got in dividends or investment appreciation. So overall, not a great experience. And then, I did the thing that most young men do once they start earning money, and they think that they're smarter than everyone else. And so I played around with buying options, and then I played around with investing in cryptocurrency, and I played around with trying to buy individual stocks, and pretty much across the board, I made money and I lost money, and then I lost more money than the money that I made. But luckily enough, I didn't have a lot of money to lose, so it wasn't that bad of a deal. Um, and it's the more that I've learned about economics, the more I've come to appreciate how little I know, right? And I think it's also that it's fairly it's a fairly good example of the Dunning-Kruger effect, is that and you can see this all over TikTok and the internet at large, is you'll have like 21-year-olds being like, the 3 stocks you need to buy are Tesla, which is down 17% this year, I believe. Uh, Beyond Meat, because the vegans are coming, and also down like 50%. And like the fact of the matter is that I don't fully subscribe to the perfect market economic theory where everything is completely factored in, but it is a very good way to think about the market in terms of investment, in that if you assume that there are other players in the market that spend their entire days and significant amounts of money on getting the smartest mathematicians out of the top universities and investing in huge computer algorithms to try and trade, that you don't have better information than them, which means that if you do make money in the stock market, you're lucky, right? And you can only be lucky so often. So I was talking about this perfect, is it called the perfect markets theory? I forget
Yeah,
what the
possibly.
actual name of it is, but
Mm.
anyhow,
Is it efficient markets?
efficient market hypothesis, that's the one.
Yeah.
So I was chatting with someone about this efficient market hypothesis, and he's like, no, 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 there's actually money to be made over here. And he used the classic example where he's like, a economics professor and a student are walking down the road, and the economics student says, hey, look, there's $100 lying there on the sidewalk. And the economics professor said, no, there isn't, because if there was $100 lying on the sidewalk, then someone would have picked it up by now. So the student goes up to the $100 and picks it up, and the economics professor says, "See?" Right? And and he was essentially trying to illustrate to me like actually there are opportunities over here. But I actually think he illustrated my point a lot better because you can't run a business on looking for $100 bills on the sidewalk. That is the definition of luck, right? And so if there are $100 lying around in the stock market, like that, it's a lucky find. And you can't build up your personal finance portfolio uh, on lucky finds.
Mm. Yeah. Well, there was a lot in there, but I wanted to start with something maybe a little bit more simplistic, and maybe not simplistic. Uh, what drives you to want to learn about this stuff? Because I think for a lot of people, and I mean, yeah, I'm probably on your side of the camp where I find this stuff really fascinating. But what do you think it is that drives you to want to learn about this and that maybe other people don't necessarily have or haven't thought about? Is it purely greed, or is it like what is it?
No, I think it's not necessarily greed. It's a striving for rationality, right? Is that yeah, and it's also partially just wanting to make the best economic decision. I actually think that the inverse is caused by greed, like the speculative markets like cryptocurrencies and individual stock picking is because people, when you say like, hey, one of the best investments that you can make is to invest in a broad market index like the S&P 500. It's really boring, but it could return 10 to 12% year over year. And people will see all the TikToks and YouTube videos that are like, I made 15x by buying XRP token. And so they'll be like, 12% is chump change, right? I want at least like 120% return on my investment over the next 6 months, which means that, and this is becoming normalized. Like if you go onto TikTok, it looks like these kinds of returns are normal, but those are outsized returns, and it's just that it's only the people who have made those returns or the people who are looking back at the market and being like, see, you could have made a lot of money over here, right? That are making these claims. And so it sets this precedent where people are trying to maximize their returns, but not necessarily understanding the risk profile that comes with trying to maximize those returns. It's like if you're chasing, 200% returns, you are more likely to end up with zero than you are with 200% by a long shot.
And I was thinking about it as like yeah, you're talking a lot about stocks here, and the markets, as it were. Like, has property ever factored into your goals and ambitions?
I mean, everything's markets.
Yeah, exactly. And I know from my perspective. So what I like, I've been thinking about it a lot, and I think like in a sense, I think the thing that like kind of unlocked it for me when I was starting to invest is compound interest. And this is like something that I started to learn about just by having a savings account, right? So the fact that you can have money, earn money for yourself, like, and I think naturally maybe it comes from a little bit of laziness, first of all. And I know there's also like this idea of like delayed gratification that comes into like the investing system. But I think it's more like a laziness thing. Like I don't like working. I don't think. I mean, like I don't like forced work. Like I can do like lift weights and stuff if I want to, and I kind of enjoy it. But I don't want to work, and this idea that you could have money working for you was something that was really compelling. I think when I was younger, and this is what kind of like spurred me to actually get into it because I was like, I don't know who put it to me. It might have been a teacher or it might have been something I read. It was like, yeah, if you could have $10 now, but if you like wait like a year, you'll have $11 or you'll have like, a little bit extra.
I think that's a bad example because 1 rand isn't that much money. But if you say if you have 100,000 rand and you wait a year, then you have 110,000 rand. Well, now you're working with money that actually makes sense.
Yeah, but then back then I was a kid, dude.
Yeah, fair enough.
One rand was like a chat, like 10 chappies or something, or
Yeah.
like
Oh
ten
yeah, yeah,
sweets. So
yeah.
I was like, yeah, that's great. Like, but I think that was like the first kind of unlock where I was like, well, you know, I'm. I think I was just kind of a lazy kid, and I just like to play video games all day. And I was like, well, if I can just like forego having to use that money now, maybe at some point it will reward me in the fact that I would be able to not have to work as hard. And I think that's generally tended to be correct. I think later in my life, I did also. I think I'm lucky that I had like parents who were like, my dad was kind of into finance. He was an accountant, so I think that like financial literacy came, through growing up with like a parent who knows it. But I think just the fact that you could have compound interest and also like going out and seeking a bit of it in terms of reading. So I was given like this one book. I guess when you get to a certain age, your parents get a little bit worried that you're just you're like not gonna make it financially, and they like give you this book which is like Money Matters for 21 or 20 like something year olds. And so I read through that book, and there was like quite a lot of stuff about like stocks and investing, and that's kind of where I learned a bit about it. And so when I started working, I did also just like I think I just committed a lot more into it than most people. But I don't know if it was, yeah, I feel like it might have just been laziness that like drove me to do that. But it's also like over time, I think, mathematically minded, it has become something that I'm quite interested in just in general. And I think the economics point that you point out of like understanding like how the dynamics work, and there's a bit of philosophy and there's a bit of like psychology involved in it too.
Mm.
I think that's also like something that's I've kind of grown up with. But for someone who doesn't have these skills or doesn't have this interest, do you think there's any kind of entry point that you would suggest someone to go into?
So there's actually a really interesting study of South Korean investors, and it's a broad population study. Tens of thousands of people were involved in it, and it took savings data from the whole population. What they actually found was super interesting, is that women, on average, had a better return on investment than men. And the reason that women had a better return on average than men is because they didn't care to try and optimize their stock portfolio. So essentially, they were making fewer stock trades. They were just buying predominantly broad market index funds. And so they weren't trying to game the market. And so they weren't getting hit with all these fees. And so across the board, if you're uninterested or not too sure about the stock market and stuff like that, or even if you are, I mean, like I'm fairly familiar with it right now. I just don't believe I can beat it. Is the best thing that you can do is like invest in a broad market index fund, because it exposes you to everything from real estate to tech stocks and precious metals, et cetera, et cetera. It's auto balancing, and very, very few managed funds, like professional investors, manage to beat this, and almost no professional investors beat this uh, if they include fees, right? So across the board, you are more likely to make money using the MSCI World Index or the S&P 500. Just buy it and forget about it. However, I think that there's something else that's important over here. Is right now we're talking more about investing, but on a more broad like personal finance topic, is that the first thing that I think people need to do is they need to focus on actually earning more. And I don't mean like give up your morals and go and pursue wealth. But it's a common and very prevalent misconception that the way that people get rich is via investing. And that is not the case. People very, very rarely get rich through investing. In order for, this actually goes back to what you were saying about, 10 Rand in a year, I'll have 11 Rand, is in order to make money in investing, you have to already have a lot of money, right? Is that if you put, you know, 1,000 Rand away per year, the returns that you get on that 1,000 Rand, in my personal opinion, are not worth the having to forego the use of that money, right? And so the best thing that people can do for their financial well-being is to earn more. So this is, increase the value of the work that you do, whether you go and you get a new degree or you upskill in a different field or you climb the corporate ladder or whatever, so that the amount of money that you earn exceeds the amount of money that you spend. And there's always like that hedonic treadmill, that lifestyle creep, where the more money you earn, the more money you spend. And so the trick is to grow that gap, the gap between how much you earn and how much you spend, and then putting that away into your investments. And if you can get that right, then you know you put it a into something that earns compound interest, and you just forget about it and you carry on doing that, and off you go.
I think it's a little bit more nuanced than that.
Yeah, of course it is.
Yeah, I think you probably, I think at any stage and at any age you should be doing both, as much as you can, because I think it's investing is as much about the discipline as it is about the returns. Like just putting money away in a way that's gonna be safe is going to put you in a better position. I do agree with you can invest in stocks and you can also invest in yourself. And I think one of the things that I learned maybe later on in life is that, later than I started investing, is when I first started, I was just like, I'm going to just like live on peanuts, live on like very little, and I'm going to put the rest into like this like unit trust or savings account, or I'm going to buy like S&P, as you said. But then over time, I learned that, well, this is good. It's going to like have incremental value over time, but it's not going to be as fast as if I was to buy a course or like buy a book that was like going to put me ahead. And I think especially when you're younger, you have a lot more capacity to increase your earning potential, over the course of your life, if you are able to invest in yourself at the right time. So investing in yourself, like buying a course or going to some sort of like seminar or webinar, or like, I mean, even just investing into kind of like experiences, going on that holiday, like that can also lead to a sort of more, I guess, fulfilling life, but also later down the line, it can also open up opportunities. And so kind of like the investing in yourself, but also still having investments is a good way to think about it. Because I think the other thing that maybe people struggle with, and this is maybe something that's raised its head more recently, is this idea of inflation. I think in South Africa, we're quite, I guess, lucky in a way. We've grown up with inflation, and everyone kind of understands it. Well, everyone's had the opportunity to understand it. Like it's been like almost constant 10%, like 5 to 10% throughout our lives. So we understand the fact that money like loses its value over time, and maybe that's why South Africans are maybe more, I don't know, across the board, but I feel like South Africans have a lot more sort of money sensibility about them because of this fact that your money is like constantly like sort of getting less valuable over time. I think what I found in the UK, and I think it's probably quite prevalent in the US too, because they also had like low interest rates and low inflation, is that people aren't used to this idea of your money becoming less valuable, or it's not as pronounced. And so, they just see like, oh, I'll just put money into a savings account. But the thing is with savings accounts, that they don't usually beat inflation. And I think this is where, a lot of people are kind of losing out, is that this, inflation cycle, the UK costs of living is going up and up and up. And if you're just putting it away into like a bank savings account. Or in some cases, some of the neobanks in the UK don't even have savings facilities. So you might have Monzo or you might have Revolut. You're not earning anything on that. And then, the cost of living is getting higher. And I think that's something that should push people to want to look at least doing something that's not, just putting your money aside.
Yeah, I agree with you over there. I also think that the two best financial decisions that you can make, the first one is where you're born, and that decision isn't really up to you. And then the second decision is what you do as your occupation, right? So it's like if you're born in the UK, or if you're, hey, 10 full marks if you're like born in Norway, where there's a lot of government assistance and they've got a sovereign wealth fund, or Singapore's sovereign wealth fund has um, enough money currently that if they were to pay it out, each Singaporean would get roughly $300,000, which will sort out most people for life. Um, so, first steps, be born somewhere that is very advantageous, and also be born to a family that has a lot of wealth already. That's great. It's also really useful in starting a company because you've got a very soft landing for if things go wrong. But I'm more making a joke over here. We don't have control over that. But the second one of choosing what you're going to do is that will definitively be the biggest personal finance decision that you make. Because once you choose a track, like once you choose an occupation, is um, you know where it caps out at. Now, this is some unfortunate news, is that things that are very important to our society, like being a school teacher, like their salaries cap out really quickly. And so, unfortunately, a lot of teachers struggle uh, financially throughout their lives. Um, and it's a tragedy, but it is unfortunately a truth.
Like, to what extent do you think like governments should play in this sort of factoring? Because you've mentioned like sovereign wealth funds, and you've mentioned like teachers not being able to pay, which predominantly I think teachers are provided by the state. I mean, in some places you'd get private and public schools and stuff. Um, but to what extent do you think a government should just be like, oh, we'll look after everyone and we'll like provide? Because I think the debate has come in the UK recently about like lots of people getting grants and all these kind of things,
Yeah.
and in South Africa it's also very prevalent. But to what extent should it be that the government should provide for that teacher so that they can teach?
So, in terms of actually providing for the people, that's a whole other conversation and a whole other debate. One of the things that I have seen countries do that I think is very important and is very useful is to have a state pension, right? Because the fact of the matter is that people grow old and they eventually stop working, and people spend their entire lives working in in the hopes that by the end of their working life, they have enough money to retire on. Now, people are also very they're not very great with their money. And so if you take a look at countries where there is a mandatory pension that you pay into each month, it is mandatory in the same way that like income tax is mandatory. Then what happens is you have a population that is prepared for retirement, and they haven't, cannibalized their retirement savings to buy a new car or something like that. So I'm actually very pro mandatory pensions. Um, in terms of social assistance, it starts getting murky because I think that incentive systems need to be set up in such a way that they incentivize people to be awesome, proactive members of society and to create, value for themselves and for others. And I think that a lot of social assistance programs do the opposite, where they actually incentivize people to extract as much from the system as possible. And and that has a couple of knock-ons, right? Because it also makes the people who are contributing to the system feel more resentful. And this is very apparent in South Africa, where it's almost as if the people who create the most value are punished for doing it, which is an unfortunate situation.
Yeah, I think it's kind of spurred another thing that I thought about is one of the other sort of factors that spurs me to kind of be, I guess financial independence is this idea that a lot of people kind of strive for. And maybe it's more the case because I think in South Africa there's also this kind of very much more focus on independence as like a core pursuit. What kind of jarred me a bit in the UK is how many people it's kind of waning now, but how many people actually just completely trust the government. And I think that trust in the government is why, people are quite happy to, throw lots of money into their pensions and stuff like that. And I think the pension idea is something that's very, very good because I think a lot of financial troubles tend to come in at later stage in life where you can't really physically work as much. You usually tend to, take on illnesses if you haven't been looking after yourself or if you, just happen to be unlucky. And so, yeah, I think if you take that burden off of saying that, at a certain point you get to, you will be kind of taken care of when you're older, I think that's kind of a good thing. But I think also the independence part is something that's maybe also important is people need to kind of, it's hard for everyone, but like taking control a little bit and, having some sort of control over what happens to you. It's maybe a little bit more in the kind of, self-fulfillment and, just like, be an adult and look after yourself.
I think that this is a classic example of, if the solution starts with if people would just, then you
Oh,
don't really have a
yeah,
solution because
yeah.
people have never just. It's like so like let's take for instance pension or retirement savings. So in South Africa, there's a tax incentive for retirement savings where if you invest up to a third or roughly a third of your income into a retirement annuity, then that is only taxed on the withdrawal of that money. It's not taxed currently. So it's kind of like some tax savings up front, which sounds pretty good because it means that you can put uh, more money into your retirement in any given year. However, I've recently gone and set up a spreadsheet to calculate if this actually makes sense over time. And it should make sense, except that the government is like, okay, retirement annuities, we're going to get people to invest in them. But then they're also like, these retirement annuities should predominantly invest in South African companies. And by making that decision across the board, all retirement annuities pay or have returns of about 5% less than something like an index fund that you can invest in. And so that leads to the problem where even with these generous tax advantages, at the end of I've got 30 years until retirement, and that's the calculation that I did. I will have a third of the value of if I had just self-invested it, even if I don't get those tax advantages at the end of the 30-year period. And so the government is like, hey, we should get people to save for retirement. And they did that. But then they added a little bit of another agenda as well, as governments are wont to do. And they went and they messed it up.
Yeah, I think maybe that's, yeah, I think South Africa is also in a kind of unlucky position because it also has this like exchange rate problem, right, where the rand is losing its value against like sort of the dominant currencies. Um, I mean, I think the other kind of topic that I've heard like talked about on online is this idea of inclusion in the financial system. Like I agree with it because you often hear of people saying, "Oh, these like companies, all they're looking out for is their like top shareholders, and they don't look after their employees and it's all the money's going to shareholders. It's like, well, actually, like you can become a shareholder quite easily. Like if you don't like the way that Amazon works, you can become a shareholder. Okay, you're not going to be like, benefiting hugely, but like I think this idea that you can have a sort of part in the growth of the economy, and if you're investing in South African stocks, you're kind of entice, like you want South Africa to grow, and I do agree with that. But I also understand that there's a sort of exchange rate problem there too. But I think this idea of inclusion is something that wasn't necessarily available to people before our generation.
I think people aren't aware that they are already those shareholders. If you have money in a savings account in your bank, your money is invested in a broad range of things from real estate to tech stocks. And if you have any money in a retirement annuity or in any form of retirement savings, you are the shareholder, right? It's just you have, like, you've probably not read where that money is invested, but you are that shareholder. So when people make the complaint that, like, these big greedy businesses, all they're interested in is increasing shareholder value, the the biggest holders of shares are retirement funds, like across the board. Retirement funds um, hold the most stocks value, and so yes, they are trying to increase their shareholder value. The shareholders are predominantly individuals.
But yeah, I think the thing with I think the disconnect that needs to be solved maybe in the next couple of years is this. I guess it's just the visibility part. Like, I think one of the biggest unlocks for South Africa was easy equities. And for those who don't know, it's kind of like the Robinhood of South Africa. It's not as good as the Robinhood app, but it basically allowed you to have like commission-free investments into stocks, right? So I think before then, one of the biggest problems was in order to invest in the stock markets, you had to first of all know a broker. They would charge like a minimum of like 1 or 2% of the whatever transaction value, and then they'd have a brokerage fee. At which point, I think I worked it out to just do a minimum sort of investment with a stockbroker back then was about 40,000 rand, which for a lot of people is like way too much. If you want to just that's just to have like a low fee base, because if you had anything lower than that, your fees are going to be too high that you need to have like an outsized return to make any money. But I think the thing with pensions is that it's kind of a little bit hidden, right? So I think a lot of people don't really have access to see that sort of growth over time. And I think that's maybe something that I've kind of like coming about recently, is that you can kind of have a little bit more of an active control in it, in what you invest in, and you can see. And in the UK, they have this cool program where you can have a self-administered sort of pension where you can like choose, how your pension is invested in a sense. Which also gives you a little bit more of a sense of like feedback, right? Because with a normal pension, you're just like hoping that at like 65, or when they push the age up to 67 or maybe 70 by the time we retire, it'll be like you only see it then, and then you might not during your lifetime know that this is actually happening. And so that like visibility part is something that kind of needs to be solved. I think to kind of like clear up and sort of close off, like, what would you say is one piece of advice you would give to anyone who wants to start this journey of understanding how to know more about the markets, or where do you think people would start?
I think that there are two good channels to take a look at, two YouTube channels. One is called The Plain Bagel, and the other one is called How Money Works. And they are both rationalist investor advice pieces. They're not going to try and teach you how to trade stocks. They're not going to shill crypto. They're not going to, tell you to buy Tesla. Instead, they'll give very rational investment advice. Oh, they'll say it's not investment advice, but it totally is. Um, and their advice is more generally, you know, put money away, put it into a broad range of investments, or into a fund that invests across a large range of industries. and then just don't touch it. Just live your life. What about you? What's your words of advice?
I would say um, I got a lot of my knowledge from reading books. I would say like I mean they kind of seem a bit cliche, but like books like Rich Dad Poor Dad and I think it's Ray Dalio's Principles. Like although Principles is quite a thick book, but like those kind of books that are like the basis of like financial independence and learning about the stock market and stuff. I'd say those must be like people should just like either like go into ChatGPT and ask about it or like just read it. Like pick up a book and just kind of learn about it. But I think the other thing to think about is this idea of diversification is like don't put all of your eggs in one basket and kind of be curious but also skeptical. Like I think the
But be
biggest.
but putting all your eggs into one basket is the American way. What you do is all of your savings go into not just the property market, but one house in the property market.
I mean, that's like a whole other discussion
That's a whole other
which
thing.
we can't touch on. But yeah, just I think like it's never been easier to educate yourself, even if you're like on the bus, like on your way to work. Like you could take like 30 minutes, listen to a podcast about it, listen to,
Yeah,
you
but don't
know,
go down the wrong rabbit holes.
don't go down the wrong rabbit holes. And I think also, again, South Africa has a little bit of an advantage. Like I grew up listening to the Money Show and things like that on like
Yeah.
Cape Talk. These things are available, but I think just like dipping your toe in gently and then, growing from there. I think that's the best approach.
Stay safe out there, yo.